There was a time when FaZe was the name in gaming. They had the largest Call of Duty team, the most famous Fortnite players, and a CSGO team that could compete with the best of them. Over the last few years, though, things have been on a massive decline. Things don't seem to be getting better either, with their most recent issue being a possible delisting from the NASDAQ due to their share price falling below $1. Considering at its peak, FaZe was trading for nearly $20 a share, you can see that this is quite the unprecedented downfall. But how did this happen? Most of us are familiar with the story of how FaZe came to be. Some friends came together to hit trick shots in Call of Duty. They decided to make montages and showcase their skills, and over time they built it into a brand. They managed to integrate product sponsorships, sell merchandise, and slowly scaled it into an esports team. From there, they became not only a powerhouse for content creation, but esports competition as well. They had some of the largest stars in social media like Tfue, Rug, and Jarvis, and some of the best teams in CSGO and Call of Duty. However, things weren't always going to be smooth sailing. As Fortnite neared its peak, there began to be issues with Tfue trying to escape his contract. This led to some ill will towards the brand from his massive fan base. They also ended up losing K and Jarvis due to their own misguided decisions, and found themselves with an increasingly weakening content team. This, however, seemed to be smoothed over going into 2022, when the prospect of going public was on the horizon. Going public is when a company becomes listed on the stock exchange. This means that it can be bought and sold by investors around the world. This opens up massive amounts of capital infusion, which in theory can be used to grow the business even faster and provide value to shareholders. It also provides quite the payday for people who already held equity in the company. If you go from owning a brand that isn't really valued on a multiple to owning a publicly traded company, you can make tens of millions of dollars. That's exactly what happened at first. The ownership of FaZe held on to 68% of the shares going into its IPO. When the company IPO'd, it had a valuation of $1 billion. That means the equity divided up amongst FaZe's owners was worth an astounding $680 million. At first, the share price seemed to be headed in the right direction, and in August of 2022, it found itself at an amazing $20 per share. But that's when trouble struck. You see, there's something called stock dilution that can drop the share price instantly. The way the stock was valued was that there were only X million shares that made up all the equity, and when you divided the valuation by the shares, you got the share price. Dilution is when a company adds more shares without increasing valuation. This means that the shares after dilution will be worth less, as they're literally a smaller piece of the overall pie. In October 2022, FaZe announced it was going to be selling an additional 70 million shares. This announcement came with the news that they were filing paperwork to allow insiders to sell shares. These two, in conjunction shortly after the other, started a lack of investor confidence in FaZe. Most investors had already made a considerable profit if they'd been in since the IPO, so when it was announced that they would be selling 70 million more shares to dilute the price, many investors decided to dump the shares before they could lose value. This led to an astounding 34% drop in a single day, as investors began to take massive profits. The shares they were going to be selling didn't do much to increase investor confidence either, as many investors found it odd for them to be needing to raise such massive funds just months after going public. Another issue was that as the share price continued to fall as investors took profit, the newly issued shares were going to raise less and less capital as the price fell. The original idea was to sell the additional 70 million shares and raise money to fund growth, but those 70 million additional shares, now worth 34% less before they're even issued, then the funding is equally affected. This basically put a crunch on the stock, and then a death note came in: shorts. Shorts are a form of option trading that profits off of share prices falling further, and when shorts pile onto a stock that's already going down, it can make it even harder for that stock to have a meaningful rebound. Things got even worse when it was announced that FaZe was legitimately concerned with the fact that it was having substantial doubt that it would be able to survive the next few months due to a lack of funding. Keep in mind, all of this is going down under 6 months after the company went public in the first place. FaZe basically was forced to announce that they were teetering sitting on the brink of bankruptcy. Things became even worse when it was announced that they had accepted a $100 million pipe loan, but were most likely going to be forced to default on over $74 million of the loan. On top of all these already price-crushing problems, it was announced that 92% of FaZe's original shareholders had accepted a cash-out option, meaning they sold their stakes in FaZe. This caused another $165 million drop in their account, and all of these occurring just 6 months after the company went public made sure almost no serious investor would be willing to take a gamble on the team. Now, all of this would already be bad enough. They basically have announced they're nearing bankruptcy. Somehow, though, things are looking worse across the horizon. You see, FaZe is publicly listed on a stock exchange called the NASDAQ, which is one of the largest stock exchanges in the world. Being listed on an exchange this large comes with a certain prestige and trust from investors. However, there are certain rules to be listed on the exchange. One of these is that your share price has to be worth at least $1 to be considered worthy of being on the exchange. FaZe initially opened up with a share price of $13 per share before climbing to $20 and almost doubling their initial valuation. Now, however, the stock price has plummeted to just 75 cents and faces being delisted from the NASDAQ. This would hurt investor confidence even further and almost guarantee a bankruptcy or restructuring. They are already defaulting on massive loans, and being delisted most likely would come with a further price drop. All in all, FaZe initially became a public company with a market capitalization of over $1 billion, but it's sitting at only $54 million as of the time of this video. Considering they've just defaulted on a $74 million loan and only have an entire market capitalization of $54 million, you can see just how much of a disaster this is turning into. Beyond that, there's also the massive problem of there just not being a smooth, predictable path to extreme profitability. FaZe's entire business model is mostly framed around being a lifestyle brand, primarily focused on gaming. They do make good money from merch and selling products. However, some of their earnings also come from things they don't have too much control over, like esports winnings, content revenue splits, and brand partnerships. Sure, when the brand is doing well, it's easy to sign the hottest content creators and brand deals. But when you're on the brink of bankruptcy, that becomes a dramatically less appealing offer. Most content creators that would actually make a dent in terms of being profitable don't really need FaZe. If you're a top 100 content creator in the world, there's no reason to give FaZe a split of your revenue if you can do it on your own. Look at how Tfue almost immediately started looking for ways to get out of his contract once he became one of the biggest creators. As for the esports side of things, sure, you can assemble a roster that's great on paper. However, if your teams don't manage to rake in major prize winnings consistently, it doesn't really turn it into a majorly profitable industry. Most of these teams also heavily benefit from sponsorship deals, but as the brand becomes less and less popular, the willingness to pay for the sponsorships go down. That isn't even just something occurring to their esports team either, but the brand overall. As their overall viewership drops, the appeal of a brand to sponsor FaZe as a whole goes down as well. And considering that the FaZe channel has been on a consistent decline, it's easy to assume brands are becoming more skeptical of their partnership. There's another issue as well. Remember that period where FaZe was recruiting rappers, athletes, actors, basically anyone with a platform? Well, that didn't come for free. According to reports from Forbes, they had to pay Snoop Dogg an estimated $1.9 million in FaZe stock, $248,000 to his son, and $248,000 to his wife and business manager's business. We're not sure how the rest of the potential member deals are structured, but overall, if you need to be paying people to join your team, it doesn't seem like a sustainable business model. Not to mention that these deals aren't permanent either. Snoop Dogg's deal only runs until 2024, meaning that this model at current share prices is dramatically unsustainable. They can't afford to re-sign all of these massive celebrities with current share prices and valuations. Overall, FaZe is facing a challenge of multiple weak points in their business that all in all are pointing towards an inevitable bankruptcy. The fact that all sectors of their business appear to be struggling at one time is not a good omen overall. It's a sad decline for what was once one of gaming's most beloved brands. It seems like the pressure of becoming a publicly traded company and meeting the financial demands necessary was just way too much for the brand to handle, unfortunately. Maybe they'll make a superhero-level recovery. Either way, this is the current economic disaster of FaZe Clan. If you enjoyed this video, be sure to check out our other videos on the gaming industry, economics, and finance.